So you came a long way, right? We learned about Fama-French three-factor models and then how to estimate those alphas and then the beta coefficients for each factors. Now, the last step would be evaluating the performance of your portfolio using back testings, right? Now, this is what you're going to do for your final project as well. Imagine that you came up with a nice investment strategy. Okay, by that, let's assume that you constructed a portfolio. Keep on constructing a portfolio, and then you want to see over time how much of an alpha does it generate when you control for those risk factors, right? N different factors, right? So that's what we're going to do using R over here. As an example, portfolio strategy, what this guy came up in chapter 13 is QMJ, quality minus junk strategy. So high quality company minus low quality company. Somehow, those high quality companies are not correctly priced, right? Compared to the junk companies. Maybe more people are disproportionately going for junk companies for no reason, whereas they don't pay too much attention to the high quality companies. That may be why those high quality companies are getting more better price in the future, right? So that's coming from this guy's research paper, Quality Minus Junk, Lassie Peterson's paper in Review of Accounting Studies. So how to test whether these quality minus junk trading strategy earns money or not. Okay, let's say you came up with this, yeah, as in Asnes, Frazzini, and the Peterson paper. Review of Accounting Studies, that's top accounting journals, and accounting and finance, we go together in that sense, right? Why is it published in accounting journals? Because it is using accounting data as a quality measure, quality versus junk. Like those quality, they use accounting growth, accounting profitability, and then safety, like related to bankruptcy or something like that. And then payout policy, all those accounting numbers seem to matter. That's why they published in accounting journals. Anyway, QMJ strategy takes long position for high quality blue chips and short positions for low quality stocks. High versus low quality would be determined by accounting performance of the thousands of firms in the market. You are essentially creating a long short portfolio and test whether the portfolio performance delivers positive alpha. If the market is efficient, what should happen? The alpha should be no different from zero. You cannot reject the null, right? But if you find the alpha being significantly different from zero, maybe the market is not efficient and you found out some profit-taking strategy. You have a go. Anyway, the return on this QMJ portfolio could be downloaded from AQR Capital Market, which is the hedge fund created by this guy, okay, Lassie Peterson. Our textbook for your next month. Hugely interesting and then important book. Yeah, and then the URL is shown over there. You would be able to download QMJ portfolio as well as factors. Portfolios are formed based on 4 quality criteria: profitability, growth, safety, and payout. They sort the stocks into 10 bins. Worst quality, P1, all the way up to highest quality, P10. Alright, so 10분위 수, 1분위 수 kind of things, right? Then each bin is a portfolio of stocks, so obtain the portfolio returns periodically, either monthly or daily. Then the strategy of QMJ would be return of P10 minus return of P1. This is called factor in the data. The twist is that you do P10 minus P1 for small stocks and do the same for big stocks. Why? Maybe there is a concern that those findings will be driven by size factors somehow. Even though we are controlling for size factors, but just to be strict, right? Doing it manually each time would be crazily tedious. So why not use our code to do that? So for that purpose, I installed all those packages and then ran to download and check out their sheet names. Okay, Excel sheets, right? So that what you see over here are those sheet names, tabs, right? And then for each tab, we are going to extract the data, especially the date column and then global column over there in that data. Do you want to see that data somehow? Yes, it is in my download folder, and quality minus junk factor monthly XLSX, double click it, and then it's 1.8 megabytes only. Okay, so let's open it up somehow over here. Yes, AQR Capital Management. Nowadays, those hedge funds are doing this kind of business to market themselves. You have a lot of different tabs going on over here. You see all those explanations. What you need is market index, market factor, and then size factor, book to market factor, and then up minus down that momentum factor. And then for each factors, right, you see different countries variable coming in over here. And then what you need is a global one, global over here, right? And then the data date values over here. So we're going to download the two columns for each tab, and that is these command that you see. Okay, QMJ, MKT, SMB, HML, and UMDRF. We're going to download those things and then place it into our data set respectively. Good. Then using inner join, we want to merge all the data based on the common index of date. Some factors start earlier than other factors, like momentum starts later. We use reduce function because inner join can jointly only join only two data sets at a time only. We need a handful of data sets to join simultaneously. So for that part, set names function lets you input the name of the columns. Each factors have different starting points. So NA omit function will delete all those observations with missing values and let you start at the common starting date. Mutate function lets you transform data. Date is the MMDDYY format, so it transforms into date format. TKXTS function transforms the data into time series format. It sets date as the index. After that, date automatically drops out. So don't be afraid of the warning signal, the warning message that you get in the following command. Yes, okay. And then here's one more thing that we want to obtain. 경고 message들, warning. Don't worry, it's okay. Another thing that I want to point out is that 이현열 박사, right, who wrote this book, had a typo over here, very important mistake, by the way, which is he was subtracting, right, RF, risk-free rate, from QMJ factor. But that he should not have done that, because he was trying to use this as a dependent variable, QMJ minus RF, as an excess return of your QMJ factors with respect to risk-free returns. But that's bad. That's not good. Okay? That's a mistake. Why? QMJ in and of itself is an excess return. You see? Quality minus junk. You subtracted junk's return. You already did it. This is an excess return. So this is a risk premium in and of itself. So you don't need to subtract. You should not subtract risk-free, okay, rate over here. So I just did that over here. Just nullified all these things. But the rest of it are okay. And then performance evaluation of QMJ portfolio and risk matrix. Okay, has to be done. Yeah. And here we use performance analytics. What is the cumulative return of QMJ portfolio? We wanna see that. Yes, QMJ portfolio seems like it's performing very well, and it has been performing extremely well over the last couple of decades. Good. Okay. And then cumulative return over the entire period, and then arithmetic average annualized return, and then geometric average annual return, annualized return, and return volatility of QMJ portfolio, and then return volatility annualized of QMJ portfolio shown differently, right? Yeah, annualized, right? And then Sharpe ratio, okay, is also shown, okay, Sharpe ratio. And then drawdown, yeah, we studied that before, right? Drawdown period is shown, yes, yes. And then maximum drawdown, yeah, is shown. And then the library, okay, we create these library of lubricant and then TIDYR and ggplot to do some of the further analysis. And then ggplot and themes, right? Yeah, here we do it. What we're doing over here is obtaining monthly average return of these factors, right? These portfolio factor portfolios, right? Apply year parentheses function enables you to compute annual return of the QMJ portfolio. ggplot function enables you to draw some bar charts like this on your right hand side. Make sense? Now, regression of QMJ portfolio return against the Carhart 4-factor model, which is Fama-French 3-factor plus momentum factors, UMD, right? Why do we do this? One, we want to check if your portfolio QMJ of your cool investment idea has delivered some statistically significant positive alpha using usual factors of risk return model like Carhart 4-factor or Fama-French 4-factor, the same thing. If alpha being positive is positive, your investment idea has a go, at least in the backtesting sense. Of course, no guarantee. There's no guarantee that alpha would keep on being positive in the future, but it is still better than having no idea at all about your trading strategies. And then number two, we want to analyze where your portfolio return comes from, okay, by looking at the factor loadings, the factor betas, right? i.e., we want to do some factor analysis to see where the risk of your portfolio comes from. Put another way, we want to know what kind of systematic risk is affecting the performance of your portfolio cool investment strategy. Except for the alpha in the discussion above, your return premium should be explained away by the risk factor Z. And beta coefficient of each factor is loading onto the risk factor. So the sign and magnitude, positive and significance of each beta coefficient tells you about how much your portfolio loads onto that specific risk factor. For example, if your beta coefficient of SMB factor is positive and significant, it means that your portfolio is composed of smaller stocks than big stocks. Okay. Okay, so we run a regression. What's the dependent variable? QMJ factor. What's the explanatory variable? That's market access, and then SMB minus HMM, not minus, and the UMD up minus down the momentum factor. And then summary of this regression shows up like this. Holy cow, the alpha is over here. Is it positive or not? Statistically, significantly positive, 6.7. Wow. And p-value is like many times smaller than a 1%, right? And then not only that, okay, the alpha, the intercept itself tells us about, wow, you have a go. Yeah, good investment strategy. But each beta coefficient tells us an interesting story about your portfolio. Showing the result in more academic research paper style, you can use this command like this, and then stargazer, because academic research paper, we use a lot of stars. I see a lot of stars. Whenever there's a statistical significance, we use stars. That's why it says stargazer. And then represent it or export it into this kind of format. And then you can copy and paste it to your Word file accordingly. Okay, interpreting the result is an important part. Lasting, okay? Lasting first and first thing last, right? 2 first and 1 last. What do you mean? There was a discussion 1 and 2, first and second above. Market beta, right, being negative, that statistically significant. It tells us that the portfolio based on quality minus junk strategy goes to the opposite direction of the whole market. Maybe during the bubble time or boom time, people go for junk stocks so much, and then they desert quality stocks. Okay, they may take it for granted. Look, good quality stocks, who cares? But we want some, other junk stocks that looks fancier over here. Ooh, very surprising, and then buy it, and later on crash it, so you lose money. That's why. Size beta being negative and statistically significant, it tells us that the portfolio based on quality minus junk strategy is more related to big companies than for smaller companies. Okay, makes sense. POSCO kind of companies, Coca-Cola kind of companies, bigger companies and high quality as well. But that's not the size. What this suggests is like not just the size, but the size effect is showing up in that beta coefficient or size factor loading. And then value beta being negative and statistically significant tells us that the portfolio based on quality minus junk strategy is more related to growth stocks than for value stocks. Momentum beta being positive tells us that your quality minus junk strategy is heavily dependent on the momentum. Okay, junk strategy are more likely to long the stocks in the upward movement and short the stocks in the downward movement. There are some coincidences like this. So these results are shown over here, and then you have significantly positive alpha, and then this tells two things very important, by the way. I'm going to ask you this question in your exam. 2 things. Number 1, your cool trading strategy delivered great risk-adjusted return in the past, because this is backtesting setting. The backtesting tells that you have a go with QMJ strategy here in this case. That implies if you're a hedge fund managers, you must have made a lot of money. Ka-chung, 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 ka-chung. Yeah, you see that. Yay, man. And then B, well, the same result, the interpretation works like this. You found a new risk factor that was not previously studied before. You can publish in a top journal of finance or accounting. Great for you. Okay. You found the risk factor. If you say it like that, you're more like a neoclassical economist. If you say that you found the mispricing, then you're sounding more like a behavioral finance guy. Evidence of market inefficiency. Okay, so that's it.